In this video, we're going to talk about breakouts and breakdowns and how you can learn to spot the breaks from the fakes reliably. Breakouts and breakdowns are two of the most popular and important events in trading that every trader needs to look out for, and every trader tries to catch so that they can make profits in a short amount of time. When you look at a chart, charts tend to go through these tight phases called phases of compression where there's low volatility and price doesn't really seem to move too much. Things are stable. These phases of compression are then followed by phases of expansion. And the beginning of these moments of expansion are characterized by those breakouts and breakdowns, when price finally snaps out of a tight range and starts to actually move big time up or down. So when price is just slowly ranging in those compression phases, moving up and down within a tight upper and lower limit, it's not really easy to take a trade or enter into a position in either direction, short or long, because it's not so obvious where things are going to trend. Price seems to be just stabilizing and it's within a flat area. This is why traders wait for those breakout and breakdown signals, because they're the moments when price presents the highest probability of making an actually large move in a short period of time. And if you're able to get in on that move in the right direction, you can enter and exit quickly for a pretty nice profit. So let's talk about breakouts and breakdowns. Breakouts happen when price blasts through a strong historical resistance level and then continues to run upwards. These moves are often accompanied, just like breakdowns, by high volatility and just a straight blast off through that previous resistance level that defined the compressed range. And in the other direction, breakdowns occur when price plummets through a support level and then continues to fall below it, usually with a large amount of volatility. So a wise strategy that most traders try to employ is just waiting to find a breakout or breakdown and then entering in the direction of that move so they can capture the majority of the move for a profit. But it's really not that easy, and most traders fail to enter in on actual breakouts and breakdowns, and instead they get caught in what they thought was a big move, but turns out to just be some sort of fake out, as we call it. Instead of a breakout, it's a fake out. It seems like price is going to exit the range, but then it just returns back to it. So you need to learn to tell the breaks from the fakes. And in order to increase your chances of success in properly identifying these big moments of breakouts and breakdowns and telling them apart from the fake moments, you need to first understand the dynamics of these compression phases and these expansion phases. And once you get a grasp on what the usual characteristics are of a real breakout that leads to an expansion phase, like a big move to the upside or downside, as opposed to the characteristics of a fake out where price fails to expand and just continues to range, you're going to really have an easier time telling a good trade opportunity from a less than optimal one. So first of all, no matter what chart or what symbol or time frame you're looking at, price is going to tend to range between previous resistance and support levels, or previous highs and lows, also known as pivot highs and pivot lows, much more than it is to actually break out from them. So in general, it's really smarter to expect price to actually fail to break out or break down. It's better to expect it to bounce off of a previous resistance or support level and expect a fake out instead of a breakout. And the reason for this isn't that these are just magic random numbers that seem to cause price to bounce off of them. The reason why these were previous highs or previous lows or previous resistance and support levels is that they actually represent real extremes of supply and demand in the market. They show us the limits of where traders or big players are willing to actually buy and sell. And that's what's causing these ranges to exist. Once it gets to the top of a range, people tend to sell. They're not willing to buy. And when it comes to the bottom of the range, maybe people are willing to buy and they're not willing to sell. So it bounces off the bottom and off the top, kind of ping-ponging through a range. And these ranges where this type of activity happens are what we call these compression phases. But when you're looking to actually enter a trade and make a profit and be able to set a target and stop, unless you're trying to scalp quickly within the range, a lot of the time most traders are planning to set some target outside of the range. They're expecting it to break out or break down so they can capture that big move and make an actually significant profit. And that's why we as traders like to focus on breakouts and breakdowns from these compression phases, from these tight ranges. So really, if you're trying to capture the actually big moves, you're not so focused on these phases of compression. We know why they exist. They exist because the extremes of supply and demand have been met, price is stabilizing, and oftentimes these just reflect a state of indecision amongst, everybody in the market. What we really want to focus on is these phases of expansion. How do we know, how can we capture these moments when price actually snaps out of a range so we can get in on the right direction and ride the move up or down out of the range? So while oftentimes breakouts and breakdowns happen because of some major news or change in market sentiment, we don't really need to know anything about the fundamentals of an asset or a symbol or a chart to be able to tell that an actual breakout is happening or a breakdown is happening and an expansion phase is beginning as price trends out of a range. And everybody can tell when a breakout or a breakdown might happen, right? It might happen when price reaches the upper or lower limit of a compressed range. But how can you actually tell a break from a fake? How do you know when price is going to actually snap out of the zone or the compressed area instead of just bouncing off the upper or lower limit and returning into it? Well, there's a couple rules of thumb that are well known and proven to be indications that a break from an upper or lower limit is actually going to happen. The first rule of thumb is basically the bigger they are, the harder they fall. You want to focus on strong levels that are historically important. Resistance or support levels that have held up for a long period of time relative to the chart time frame and aren't just these little intermittent local highs or lows. So the longer a support or resistance level has held up, the more times it's been visited and caused price to ricochet off of it back into a range, the stronger and more important it generally is. And the longer these levels last, the more pivotal they become. And when these important levels get broken, price is much more likely to continue running for a while, as it's been such a long time since price has trended above or below that level, and some price or equilibrium discovery needs to happen. And this potential continuation when these important levels are broken is exactly where you want to be capturing your profits. If you want to focus on high probability or high chance of success breakout trades, you really only want to focus on these extremely pivotal levels that actually provide a good risk to reward balance. The second rule of thumb is you want to look for high volume at the moment that price is actually visiting or touching that level. Once the symbol of the price starts to trade around the range surrounding that important resistance or support level, you need to be seeing high trading volume to increase the likelihood that it's actually going to break that level to the upside or downside. And the reason for this is that that level only exists as an important resistance or support level because historically there's a lot of buying or selling pressure once price tends to approach that zone. And there are a lot of orders or big traders or big players kind of protecting these levels from being broken. And if there's not enough volume, the level is unlikely to be broken. High volume is what provides the liquidity in the market needed for the actual big move, that big breakout, that big breakdown. That's going to have some continuation that you can profit off of. And even if price snaps slightly above or slightly below that important level, you think it's a breakout or breakdown, if there isn't high volume, it's probably going to lack follow through. So before you enter any one of these potential breakouts or breakdowns, wait for that high volume confirmation so you know there's probably going to be enough momentum to sustain a move that you can capture. And don't worry about missing that first candle through the resistance or support level. That's just the first leg. That's the signal. You're going to be able to ride the rest of the move after that one happens. Now, the next rule of thumb is really the name of the game for these big expansion phases that are marked by these breakouts or breakdowns. You need to see rapid expansion, high volatility. When powerful real breakouts and breakdowns occur, they usually happen fast with large candles or large bars that signify that price is changing quickly, the break is confirmed, and it's unlikely we're returning to the range anytime soon. A lot of the time this happens because traders are rushing in to enter the break or enter in the direction of the break. There's a lot of buying and selling happening as people try to enter in on the move. And as the break gains momentum, really what's happening too is that the contrarian traders who are betting against that move need to be exiting their position. So if they're long and there's a breakdown, they're selling to exit their long. They're worried that a breakdown is going to be confirmed and they're just adding fuel to the fire. And when price is breaking out, all of the people who have a short position are buying to cover their shorts and they're adding fuel to the fire in the upward direction. and it's causing this exponential acceleration in the direction of the move. So no matter what the cause is, these big breakouts and breakdowns are usually marked by rapid price expansion, high volatility, big bars or big candles on the chart. So to recap, the big three important rules are: number one, these need to be historically significant resistance and support levels if you want to be capturing a big breakout or breakdown. If it's just some intermittent little level, some local high or local low, yeah, it might go a little higher or lower. It might still remain within the overarching range relative to the chart or time frame you're on. Number two, you really only want to be trading or looking for these breaks that have high volume accompanying them. It's not the be all end all, but it is a good sign that there is momentum to be had and there is a move with continuation coming up. And third, and probably most importantly, is price is often rapidly expanding when there's a real breakout or breakdown. Volatility picks up and the size of the bars or candles accelerates, signifying that there's people exiting their positions, there's people entering positions, and a shift in the market is happening. A compression phase is over and an expansion phase is beginning. And if you can pay attention to all these steps, the volume, watching these historically significant levels and looking for a rapid expansion or a relatively large increase in volatility relative to the chart you're looking at, you're going to increase the probability that you are entering in on an actual breakout or breakdown.
And now for the big reveal, and that's that you don't have to do any of this manually. We've developed an indicator called Volatility Crusher AO, or auto-optimized, that does all of this work finding these explosive breakout and breakdown opportunities automatically. Now this indicator has a very advanced breakout and breakdown detection algorithm, and it's built to spot and signal these explosive breakout and breakdown moves that offer such great trade opportunities, usually leading to big trends to the upside or downside. And the way it works essentially is really based on these telltale signs and rules of thumb that we just covered in this video. So it's programmed to look for those telltale signs of confirmed breakouts and breakdowns, such as price testing against strong support or resistance levels, a big time increase in volume, or rapid price expansion at high volatility, which is that topic we just spoke about earlier, where rapid increasing expansion is usually a sign of a confirmed breakout or breakdown. So everything we covered in the video, this indicator does automatically. But that's not it at all. It's not just signaling these breakout and breakdown opportunities. It's actually providing you an entire trading system in one indicator. It plans out and offers you these trade opportunities and trade ideas that come complete with entry signals to the long and short side, profit targets for every entry signal triggered, and a stop loss that trails. And these targets and stops are intelligently placed based on the relative action at the time of the entry signal. And not only that, not only does it have this trading system with entries, targets, and stops, but it also has real-time win rate statistics for those trade signals right on your chart, so you can see what the actual historical performance has been for the trades that this indicator is signaling, no matter what chart you apply it to. And these statistics update in real time. And that's still not all. The most powerful part of this indicator is that it uses a machine learning approach to auto-optimize or self-optimize itself and the way it's looking at your chart, so it does the best job possible of signaling these high probability breakout and breakdown opportunities. And what it basically does is look back over a historical period and test out up to thousands of different parameters and configurations for triggering entry signals and placing profit targets and stop losses, and then it optimizes and selects, which setup or which approach is working best for the chart, time frame, or symbol that you have applied it to. And it's going to work on any time frame, any chart, and right when you apply it to the chart, it's going to self-adapt and fit itself to that market, to that chart, and that price action that you've put the indicator on. So without further ado, let's hop right onto a chart and take a look at this indicator and explain how it works. And before we do that, I just want to point out that this indicator is available for many trading platforms, such as TradingView, NinjaTrader, MotiveWave, MetaTrader 4 and 5, TradeStation, and more. So if you don't see your platform being used in this video, don't worry, there's a good chance it is supported as well. So despite being a very powerful and actually advanced indicator, Volatility Crusher is really easy to read, it's easy to understand, and ultimately it's very easy to use. So let's start off by taking a look at the indicator on the chart here and talking about what we see once it's applied. So as we know, volatility crusher is all about capturing those big explosive moments when the chart shifts from being in a compression phase where price is ranging tightly to being in an expansion phase where price begins to trend and is now broken out to the upside or downside from a compressed range. And with that in mind, let's take a look at what is probably the most obvious visual on the chart, which are these boxes here, these highlighted areas. And these boxes are always drawn preceding an entry signal. So we can see a box here, an entry signal, a box here, and an entry signal. And these boxes, these zones, are called compression boxes. And what they're showing you is a visual of the compressed range from which price action has now broken out or broken down from at the time of the entry signal. Volatility Crusher has its own unique algorithm internally to detect and track very minute changes, measurable changes in relative compression and expansion. So its proprietary approach is this unique algorithm for tracking relative compression and expansion in price candles, price bars on the chart. So while some of these regions might not look compressed, the indicator has determined that price is expanding in a significant manner, enough to trigger one of these breakout, or in this case on the left here, breakdown signals that are likely going to lead into a trend, which we can see here. Despite this not looking very compressed, it's the size of the candles that defines the compression and expansion that the indicator looks at. And the next visual that's the most important is the entry signals themselves. So on the right here, you can see we have 3 long entry signals all in succession. And then on the left here, we have this short signal, a breakdown signal. So these are short signals for breakdowns and long signals for breakouts. And entry signals occur when 3 key conditions happen simultaneously. First off, volume and volatility have ramped up to abnormally high levels relative to recent action. So let's take a look at some of these breakout signals on the right here, these 3 breakout signals. We can see that at each of these breakout signals, in the price action surrounding it or on the bar itself, there's a spike in volume. This one has a spike, this one has a spike, and this one also has a spike in volume. That first condition is met. The second condition is that rapid expansion, that volatility is increasing. And on all of these signals, we can see volatility definitely was increasing. The size of candles was expanding, or price had gapped up and made a big sudden move. And the next condition is that price is snapping out of the compressed range preceding it. And that, of course, happens in all of these cases. Here on this breakdown signal, price snaps out of this little range it determined and meets that criteria of a technical breakout or breakdown from the identified recent price action. And finally, the last condition for one of these signals is that momentum needs to be accelerating dramatically in the direction of the breakout or breakdown. So we can see over here, price snaps below support, and price is definitely starting to trend downwards at an increasing rate. Momentum is heading down. And on this side over here for these breakout signals, we can see that momentum is definitely ramping upwards to the long side. Now, the next thing we look at on the chart are these purple and pink lines. The purple lines are profit targets. This is your first profit target and your second profit target, in this case for this long trade entry. And the pink line down here is the trailing stop loss for that trade. These targets and stop losses are generated automatically with every entry signal, and their distance from the entry price or the entry bar is based on a ratio or percentage of the size of the compressed range from which price is now expanding. It uses its own intelligent method of placing targets and stop losses at realistic distances relative to recent price action, so that it's always naturally adaptive and fitting to current conditions. And it's placing these targets and stops at a point that's determined to most reliably secure profits and protect against losses. And last but not least, we have the statistics panel in the bottom right here, where we can view information about the trades that the indicator has been signaling. We can see the win rates to both the long and short side for these signals and these targets and stop losses that the indicator has triggered over its look back period. So we can see in this case, from the most recent bar to October 12th at this time of day on this 30-minute chart on NQ, 93.33% of all long trades hit their target, and 100% of all short trades over that look back period hit their target or stopped out at a profit. And these win rates are super valuable. They give you extremely important information once you apply the indicator to a chart, because they're telling you if you can even rely on these signals whatsoever. Now, in this case, the indicator is working extremely well on this chart, and that's because it has optimized itself, which we'll cover in a moment. But we can see 93% of long trades are succeeding 100% of short trades. So if you get a signal, hopefully historical performance in this case might carry out a bit into the future. If you get a signal to either direction here, you know that historically these are working out extremely well, and it's probably a reliable signal. And conversely, if there is a less than optimal win rate, maybe something like 50%, well, that's also valuable information. Sometimes the best info you can get is telling you not to trade, to avoid the signal from the indicator on that time frame. But that's where the magic of Volatility Crusher AO really shines, because AO stands for auto optimization. So it's very rare you're going to apply this indicator to a chart and see a bad win rate, because all you have to do is at the click of a button, hit optimize, and the indicator, we can see down here, it's telling us in that split second just tested 144 different approaches, 144 different angles of looking at this chart and time frame to find the most reliable way to trigger these trades, these entry signals to the long and short side, and place these targets and stops such that we get those great win rates. And if we change time frames, so I'm on the 30-minute here on NQ, if I go over to the 2-hour chart, the indicator automatically optimizes itself once again in the blink of an eye. So we can see now I'm on a 2-hour chart. Our long efficiency, or our long win rate, is 76%. Our short win rate is 89%. And that happened in the blink of an eye. All I did was change time frame. I can change symbols, and it'll instantly optimize to fit that chart as well. So I've now hopped over to TradingView. I've got Volatility Crusher on the chart here, and we can see on every platform it's functionally the exact same. We've got those same visuals with the signals and targets and stops. We've got our statistics panel up in the top right with the win rates and the optimization information, and we've got all of our settings. And what I want to bring up here is that truly everything in this indicator is customizable. So everything we spoke about, the way the indicator detects and tracks compression and expansion, the look back period it uses to find these compressed ranges, the ratio or percentage of the compressed range size it uses to place targets and stops. All of these values are available to customize in the settings. There's so many parameters because it truly is a complex indicator. There's also tons of useful stuff. There's also one of my favorite features, trading style, which allows you to tell the indicator to go long and short, so generate long and short signals, or only generate one or the other, only long or only short. And what this is useful for is, number one, if you're only a long or short trader, but also if you select long only, well, the indicator's not going to have to optimize to get that good short win rate. It's only going to focus on optimizing long win rates. So if you're long or short biased, you can definitely use that feature to your advantage. And really the point of auto optimization is that you don't even need to know what any of these settings do. It could be useful to know, but you really don't have to, because the optimization process automatically tests a massive number of possibilities for these values and then applies and uses the best possible ones, the ones that are giving these high win rates, like an 86% long win rate, a 100% short win rate. And if you were to fiddle around with the settings manually, that might take you forever to get such results. This is the power of this machine learning, this optimization that happens instantly. And everything else, like the visuals, are also, of course, customizable, all your colors and everything. And you can do stuff like turn off the bar coloring or turn off the compression zones or compression boxes on the chart. And really the whole point, to condense it down, of Volatility Crusher is to show you these super high probability breakout and breakdown signals that are proven with win rates that you can confirm. So when the indicator shows you something, this long signal or this short signal, this long signal, you know immediately that historically, hey, 86% of long signals, just like this one, have hit their target. So you've got that information in hand, and it'll help you make better judgment calls or have confidence in the trade, be able to tell what's going on a lot better, and actually assess if the signals from this indicator are worth listening to. And most of the time they are, because they are optimized, and they're always optimizing to fit the chart it's applied to. And depending on the platform you're on, you are also going to be able to scan across massive buckets of symbols for these high probability or high rate of success long and short signals, breakout and breakdown signals. And you're even able to filter for the ones that have these high win rates. So you can run a scan across however many instruments you have access to only look for breakout and breakdown signals on some specific time frame with a specific win rate historically. And that's super powerful because with this auto optimization, Volatility Crusher is identifying these breakout and breakdown opportunities better than any trader possibly can. So thank you so much for watching. I hope you gained something useful from all this information about breakouts and breakdowns, and that you give this breakout and breakdown indicator, Volatility Crusher, a try.